All right, folks, let's kick things off with some fresh news from Wall Street. Morgan Stanley just dropped their latest list called 30 for 2027. Basically, it's their handpicked lineup of 30 high-quality stocks they believe are going to stay strong and keep growing all the way through 2027. Now, the big idea here is that while the overall market feels pretty shaky, with policy changes, earnings forecasts getting trimmed, and a lot of uncertainty, Morgan Stanley thinks certain individual companies still stand out as long-term winners. Some of the big names won't surprise you. Walmart, Apple, Amazon, Microsoft, and Meta all made the cut. These are the kinds of companies Morgan Stanley believes will keep delivering value even as the market faces challenges. So, the theme here is quality. Their analysts believe that by focusing on strong, resilient businesses, investors stand a better chance of riding out the bumps and actually outperforming in the long run. From list to investment product. But here's the interesting twist. Morgan Stanley didn't just put out a list of stocks and call it a day. They actually built a full investment product around it. It's called Stocks for 2027, and it's packaged inside something known as a Unit Investment Trust, or UT. Now, don't worry if that sounds complicated. It's really not. Think of a UT like a pre-packed basket of stocks. You buy into the basket, and it stays fixed for about 2 years. Unlike a mutual fund or ETF, nobody's actively trading in and out. Once the basket is set, that's it. You hold it until the trust expires. So in this case, Morgan Stanley literally bundled up these 30 stocks into one ready-made portfolio. And that's what we're about to break down. What's inside this basket? All right, let's open the basket and actually see what's in there. Morgan Stanley spread it across different sectors, so it's not just tech-heavy. I'll walk you through sector by sector so you know exactly where your money would be going if you own this trust. 1. Technology, about 20%. No surprise, tech leads the way. You've got the Titans, Apple, APL, and Microsoft, MSFT. These two alone pretty much power the digital economy. Then you've got Datadog, DDG, which does cloud monitoring, Atlassian, Team, known for software tools like Jira, Shopify, Shop for e-commerce, and analog devices, ADI, which makes the chips that go into everything from cars to smartphones. This mix shows Morgan Stanley isn't just sticking with old faithfuls. They're also betting on the new generation of software and semiconductor names that could be tomorrow's giants. 2. Consumer discretionary and staples, about 17% combined. Here's where the everyday economy comes in. Amazon, AMZN, no explanation needed. Chipotle, CMG, because people love burritos and margins. Ferrari race, yeah, even luxury is in the mix. And on the staples side, you've got Coca-Cola, KO, and Walmart, WMT. These are the brands people keep buying no matter what the economy looks like. This section of the basket screams resilience. It covers groceries, dining, retail, and even luxury spending. It's Morgan Stanley's way of saying people will always eat, drink, shop, and dream about fast cars. 3. Financials, almost 20%. Big money movers here. Visa, V, and MasterCard, MA, are basically toll booths for global payments. Every swipe and tap runs through them. Blackstone, BX, plays in private equity and alternative assets. Citigroup, C, and Citizens Financial, CFG, represent banking. And then there's Progressive, PGR, one of the top insurers in the country. Morgan Stanley's heavy weighting here tells us they believe finance is the backbone of the market, and these firms aren't going anywhere. 4. Healthcare, about 13%. The healthcare picks are stacked with leaders. Eli Lilly, LLY, is riding the wave of blockbuster drugs like its obesity treatments. Thermo Fisher Scientific, TMO, provides the lab tools and research gear behind the scenes. Boston Scientific, BSEX, makes medical devices, and IQVA, focuses on data and clinical research. With aging populations and constant medical innovation, healthcare is one of those sectors that keeps growing, almost no matter what's happening in the economy. 5. Industrials and energy, around 13%. Here you'll see Howmet Aerospace, HWM, which makes parts for aircraft and cars. Trane Technologies, TT, a leader in HVAC systems, heating, ventilation, and air conditioning. TransUnion, TRU, best known for credit reporting and analytics. And for energy, there's EQT Corp, EQT, a big natural gas producer. This slice captures infrastructure, energy security, and the flow of credit data that powers lending. 6. Real estate and materials. Small but strategic. In real estate, you've got CBRE Group, CBRE, one of the largest commercial real estate firms. And in materials, Ecolab, ECL, which focuses on cleaning, sanitation, and water treatment. These aren't flashy names, but they cover essential services that underpin the economy. 7. Communication services, about 10%. This is where entertainment and social life show up. Meta Platforms, Meta runs Facebook, Instagram, and WhatsApp. Spotify, Spot, dominates audio streaming. And Live Nation, LYV, controls concerts and events. This slice captures the way people spend their free time online and offline. The idea behind the basket. So when you zoom out, the trust is like a curated cross-section of the modern economy. From iPhones and credit cards, to healthcare labs, to Friday night concerts, Morgan Stanley wants to give investors exposure to the companies that run everyday life and have the muscle to keep winning through 2027. The costs, what you pay. Now, none of this comes for free. If you buy into the trust, you're paying about 2.4% upfront plus a small annual cost around 0.1%. That's not cheap compared to ETFs, which often charge pennies on the dollar. You're basically paying for Wall Street to package and curate it for you. Could you copy the list yourself and avoid the fee? Absolutely. But some people would rather pay for the convenience and brand confidence. The risks, what could go wrong, and here's the part they have to tell you, even if it scares you. The risks include geopolitical shocks like wars and terrorism, trade disputes and global supply chain issues, banking crises or market instability, pandemics or health crises, even climate risks and extreme weather. Plus, remember, it's a fixed basket. If one of these companies tanks, it doesn't get swapped out. You're locked in until 2027. That concentration can mean higher volatility compared to broader funds like the S&P 500. Final takeaway. So, what's the takeaway here? Morgan Stanley's 30 for 2027 and the stocks for 2027 trust are all about focusing on quality companies, businesses with strong fundamentals that can withstand market storms and still keep growing. But the choice comes down to this. Do you buy the trust and pay the fees for the convenience? Or do you DIY, copy the list, and build your own basket for cheaper? Either way, the list gives us a great window into what Wall Street thinks are the most resilient companies for the next 2 years. Now I want to hear from you. Do you think these 30 picks will actually outperform through 2027, or is this just another shiny Wall Street sales pitch? Let me know in the comments. I'll be reading them. And if you enjoyed this breakdown, hit that like button and subscribe. I'll be bringing you more deep dives into the biggest moves on Wall Street, the hidden details in financial filings, and the strategies that matter for your money. Until next time, stay smart, stay curious, and keep stacking that knowledge.